The Most Important Thing by Howard Marks is one of the most respected books in the investing world, written by the co-founder of Oaktree Capital Management. It is not a how-to guide full of stock tips. It is a philosophical framework for thinking about markets, risk, and investor psychology. The core argument is simple but profound. Superior investing requires mastering not one thing, but many interrelated disciplines simultaneously. Leave any one out and your performance suffers. The foundation of everything is what Marks calls second-level thinking. First-level thinking is what most people do. This is a great company, so I'll buy the stock. The problem is that if everyone sees the same thing, it's already priced in. Second-level thinking asks a deeper question. Is this asset better or worse than what the market currently believes? To outperform, your view must be different from the consensus and more accurate. Being different and wrong is just as bad as being average. Marks takes a nuanced position on market efficiency. He agrees that most large, liquid markets are heavily followed and not easy to beat. But markets are made of emotional human beings, not rational computers. Inefficiencies arise from panic selling, complexity, neglect, and institutional constraints. The best opportunities tend to live in corners of the market that are less followed, harder to analyze, and therefore less efficiently priced. Distressed debt, private credit, emerging markets. On value, Marks is firmly in the Benjamin Graham tradition. The true value of any asset is the present value of its future cash flows. Price is what the market says something is worth today. Value is what it is actually worth based on fundamentals. The gap between the two, in either direction, is where opportunity and danger live. Estimating value is genuinely hard, which is exactly what creates opportunity. If it were easy, everyone would get it right and there would be no mispricings. This leads directly to his central conviction about price. The price you pay is the single most important determinant of your return. A wonderful business bought at a terrible price will underperform. A mediocre business bought at a wonderful price can be a great investment. Most investors focus obsessively on finding great companies and forget to ask whether those companies are available at a sensible price. Marks calls this confusing quality with value. They are not the same thing. His definition of risk is where Marks diverges most sharply from academic finance. The academic world defines risk as volatility, the standard deviation of returns. Marks argues this is the wrong measure entirely. Risk is the probability of permanent, unrecoverable loss of capital. A stock that drops 40% and rebounds fully is volatile, but not truly risky for a patient long-term holder. A bond that never fluctuates but then defaults is low volatility and genuinely risky. Furthermore, risk is largely invisible until it materializes. Markets feel safest precisely when risk is highest. During booms, when leverage is building and prices are detaching from fundamentals. The calm before the storm is when danger is greatest. Recognizing risk requires reading investor psychology rather than price charts. When investors are optimistic, credit is loose. New financial products are proliferating, yield spreads are tight, and everyone is reaching for return. Risk is high regardless of how calm things feel. When fear is rampant, credit is frozen, and assets are being dumped indiscriminately. Risk is low even though everything feels frightening. The investor who can read this psychological climate and act on it has a substantial edge. Controlling risk does not mean avoiding it. Eliminating risk means eliminating opportunity. The goal is to take risks that are adequately compensated and avoid risks that are not. This is the concept of risk-adjusted returns. What matters is not raw return, but how much return you earned per unit of risk taken. A conservative fund returning 10% with minimal risk may be generating superior alpha compared to an aggressive fund returning 15% while taking enormous risks. Marks is one of the most respected thinkers on market cycles, and he devotes considerable attention to them. Everything in markets moves in cycles. Economic activity, corporate profits, credit availability, investor sentiment, asset prices. Cycles are driven by human nature. Investors extrapolate the recent past indefinitely into the future, buying more during booms until the cycle tips, then selling everything during busts until prices fall below what fundamentals justify. Understanding where you stand in the cycle is the most important macro judgment an investor can make. You don't need to time the market precisely. You need a rough but accurate sense of whether conditions are generous or stingy. Related to cycles is what Marks calls the pendulum of investor psychology. Sentiment swings between extremes, greed and fear, euphoria and despair, and never stays at the rational midpoint for long. The farther the pendulum swings in one direction, the more violently it snaps back. This creates the central opportunity in contrarian investing. When sentiment has reached a genuine extreme, assets are either deeply undervalued extreme pessimism or dangerously overvalued extreme euphoria, and the investor who can recognize this and act on it earns exceptional long-term returns. But Marks is careful to clarify what intelligent contrarianism actually means. Simply doing the opposite of the crowd is not a strategy. The crowd is right most of the time. Reflexive contrarianism would have you constantly betting against the consensus and losing. True contrarianism requires a well-grounded fundamental view of value, an accurate reading of where sentiment has reached an extreme, and the psychological fortitude to act on that reading even when it feels deeply uncomfortable. All three elements are necessary. Investor psychology is one of Marks's central concerns throughout the book. He catalogs the major forces that cause even intelligent people to make terrible decisions. Greed, fear, envy, overconfidence, capitulation, and the powerful pull of conformity. These are not defects of stupid investors. They are deep-wired cognitive and emotional tendencies that affect everyone under sufficient market stress. What separates exceptional investors is not that they are immune to these forces. No one is, but that they have built processes and disciplines that help them override them at critical moments. Finding genuine bargains requires knowing where mispricings come from. They come from assets that are out of favor, misunderstood, associated with fear, too obscure for large institutions, or caught in forced selling. The common thread is that bargains are found where other investors cannot go, will not go, or are too scared to go. The investor with analytical skill and emotional fortitude who can venture there finds the best risk-adjusted opportunities. Patience is not passive. It is an active strategy. Most of the time, the right move is to do nothing, to hold cash or high-quality liquid assets and wait for genuinely attractive opportunities. This is painful during bull markets when everyone else looks like a genius. But the patient investor earns the right to be aggressive when cycles turn and generational buying opportunities appear. The discipline of not manufacturing activity during thin markets is what preserves dry powder for the moments when it matters most. Marks devotes an important chapter to epistemic humility, knowing what you don't know. Most investors dramatically overestimate how much of the future they can predict. They build elaborate models with false precision. The superior investor works with what can genuinely be known. The range of likely outcomes, current valuation levels relative to history, the psychological climate, while building margins of safety against everything that cannot be known. Calibrated uncertainty is more valuable than confident wrongness. On the mathematics of loss, Marks makes a point that is simple but transformative. Lose 50% and you need a 100% gain just to break even. Lose 75% and you need a 300% gain. The cost of a big loss is far greater than the benefit of an equivalent gain. A strategy that consistently avoids catastrophic losses, even at the cost of missing some big gains, will outperform over long periods. Compounding works its magic only if you stay in the game. Survival is the first requirement. He catalogs the most common pitfalls that destroy investor capital. Getting the fundamental analysis wrong, letting emotions override process, paying too much for genuine quality, using excessive leverage that turns temporary setbacks into permanent losses, concentrating too heavily in single positions or sectors, and reaching for yield by accepting inadequate compensation for the risks being taken. Most of these are preventable. Prevention requires discipline and self-awareness. The book closes by pulling everything together into a unified philosophy. Superior investing, Marks argues, is the consistent application of analytical rigor, emotional discipline, genuine humility about uncertainty, and the courage to act differently from the crowd when the evidence supports doing so. It is not about intelligence alone. Many brilliant people invest poorly. It is not about better information. Everyone has access to the same news. The edge that compounds over decades is behavioral, staying rational when others are not, maintaining discipline when it is most uncomfortable, and never losing sight of the fundamental relationship between price and value regardless of what the market is doing around you.